So at the time I'm recording this video, Thanksgiving is next week. Hard to believe it is officially the holiday season, and it's got me thinking a little bit about inflation. It's not just because of all the questions I've been getting from all of you as far as what does this mean for the economy? What does this mean for my investment portfolios? But I know a lot of you are going to be doing holiday shopping. And you might be in for a rude awakening when the things you're looking for are out of stock, they have delayed arrival times, or they're just downright more expensive. So the reality is what we're going through, in a sense, is unprecedented because as we came out of a COVID lockdown, there was a tremendous amount of demand, and our supply chains just ultimately couldn't handle it. So here we are with inflation. And there's a lot of conversations out there as far as how long this inflation's here. And what does it mean for the economy? What does it mean for the stock market? What does it mean for the bond market? So I wanted to talk about it because it is something that I'm thinking about. And it is something that's important from an investment allocation perspective. So let's talk about what are the risks. And some of this has to do with inflation can have an effect on the stock market. Fundamentally, the stock market largely is a function of company profitability. So if companies are having higher input costs, that might mean higher labor, higher transportation, higher material. That can put a pressure on their margins. And consequently, that puts a pressure on their stock prices. But at the same token, if companies are finding that they're having higher costs, what they have the option of doing is raising their prices. And the question is, will consumers continue to pay those prices? Well, there's a couple of signs of good news, I think. Number one, coming out of COVID, the consumer balance sheets are relatively in good shape. People have paid off their debts. They have more money in their bank accounts. Wages have actually been increasing. The second side of it is these companies are resilient. They're resourceful, and they may be able to deal with these supply chain risks through good old-fashioned corporate planning. So it's not necessarily a foregone conclusion that all of their costs are going to be higher. And what we're seeing with earnings is, well, it depends on the company. Some companies are struggling. Some companies are managing through it A-okay. But I think what we all can agree on is the longer this inflation is here to stay, and that's an active debate going on right now. You ask one economist versus another economist, you may get wildly different answers. But the longer this inflation is here, the more challenging it becomes for consumers and businesses alike. The second side of it that can be a bit concerning is how will our Federal Reserve react to higher inflation? And to the extent they want to pour, so to speak, cold water on the economy, whether it be through tapering more quickly or raising their interest rates, that can have implications. And one of the things to think about, and I've talked to most of you about this, is with interest rates being so low, that's allowed the stock market to rise at the unprecedented rate that it's been rising. Because when we look, relatively speaking, investing in bonds has become somewhat unattractive because you're getting paid such a low, measly interest rate. So consequently, it's pushed more people into the stock market. So if all of a sudden interest rates start to rise a little bit, you may see the opposite effect occurring. The second piece you want to think about too is bonds, generally known as more safe and stable investments. And I believe that to be true, but a lot of these bonds are more interest rate sensitive, and they can actually lose money, sometimes a lot of money, if interest rates go up. So the good news is our Federal Reserve, they are careful. They've learned their lesson as far as increasing interest rates too quickly. They've seen it have a negative impact on the economy. So they're willing, and they have been willing, to let inflation run a little bit hot, and they're very sensitive about this. But if inflation gets out of control and they have to move more quickly than they would like, that's, in my opinion, where there really can be some risks we have to think about. But there are always risks out there in the economy, and diversification is really helpful here. So number one, when it comes to the stock market, some of the sectors in the market that have underperformed, let's say the last 5 or 8 years, can actually do quite a bit better in inflationary times, whether they be small cap stocks or smaller companies, whether they be the value side of the market, such as financials, or energy. The other thing we want to think about is in bonds and making sure to the extent you own bonds, and most of you, right, we have a reduced exposure to bonds. We've talked about it. For the reason alone that we're getting paid such measly interest rates to hold them, our bond exposure tends to be a little bit lower than what it usually is. But making sure to the extent you own bonds, they're not overly sensitive to interest rates. And there's, we call them lower duration type bonds. You could look at TIPS, you could look at, say, convertibles, you could look at preferreds, but all these different asset classes become important. They may help us weather this storm. Look, we ultimately don't know. As I've said, there's an active debate as far as how long this inflation is going to be here, how severe it's going to be. But we need to be diversified. We need to find ways to protect ourselves. And as always, we need to really understand what we own in our investment portfolios. So I'll keep you updated as always. But most of all, I wanted to wish everyone a very happy and safe holiday season. And as always, you know how to reach me. Feel free to call with your questions. I'm always here to help. Thank you.